Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the NRT trading strategy, a powerful method that can help you identify potential breakout opportunities by focusing on periods of low volatility. Now, this strategy is designed to give you an edge in spotting this moment when the market is about to make a sharp move, allowing you to enter at the right time and riding the momentum. Stay with me until the end of this video because I will walk you through exactly how this strategy works, how you can apply it to your own trading strategy, and what to watch out for to avoid common mistakes. Now let's look at the strategy overview. The NRT trading strategy is built around the concept of identifying periods of low volatility, which often precede significant price movement. The term NR7 stands for narrow range 7, meaning that the current bar that has the smallest range compared to the previous 6 bar. This setup is a signal that the market is consolidating and a breakout may occur soon. Periods of consolidations are often referred to as calm before the storm. When volatility contracts, it indicates that buyers and sellers are in a temporary balance. However, this balance rarely lasts long, and when it breaks, it can lead to a sharp move in either direction. The NR7 strategy helps you position yourself ahead of this move. Now let's look at the key elements of the NR7 strategy. The range calculation. The range of each bar is calculated by subtracting the low from the high. The NR7 bar is indicated when the range is smaller than that of a previous 6 bar. For this example, I will turn on the NR7 indicator to make you understand this easier. Number 2, trend filtering. You can use the 20 exponential moving average to determine the overall trend direction. For example, if prices are trending above the 20 EMA, you would look for a potential long trade, and if price is trading below the exponential 20 period exponential moving average, you would focus on short trades. Now let's on the 20 EMA. 20 EMA, change this to the 20 EMA. Now this is the 20 EMA. So once price is trading above, signals buying opportunity, and when it's trading below, signals selling opportunity. Breakout confirmation. Once the NR7 bar has been identified, you wait for a breakout above or below the range of the bar to confirm the trade direction. This breakout typically signals that volatility is expanding again and that price may continue in that direction. Now using the indicator, we can see anywhere you see 7, that is the NR7 bar. Using this indicator to make it easier for us to spot. So let's look at how we can take trades using this strategy. Now for a long position, first of all, you ensure the price is trading above the 20 exponential moving average. Like in this example, price is trading above the 20 moving average, the 20 exponential moving average, which indicates an uptrend. You identify the NR7 bar where the range is smaller than the previous 6 candle. Look at this bar. As you can see, number 7 is on top of it. The 7 indicates this is the bar. You can notice that that candle is smaller than the previous 6 candles, showing that that is the NR7 candle. We enter a long position when price break above the NR7 bar. We enter a buy position once we see price have broken above the NR7 bar, and this suggests that volatility is expanding in favor of higher prices. Now let's look at short position. Short position will ensure that price is trading below the 20 exponential moving average. Now as you can see at this area, price is trading below the 20 exponential moving average. We identify the NR7 bar where the range is smaller than the previous 7 candles. This particular bar here, this bullish small bar, is smaller than the previous 6 candles, the range of the previous 6 bar. We enter a short position when price breaks below the NR7 bar. At this area, when price breaks below, we would enter a selling opportunity below this area. This breakout signals that the volatility is expanding in favor of shorter or of slower prices. Now let's look at our entry tactics, how we can enter this trade. Patience is the key when entering trades using the NR7 strategy. Here are some important tips you can use for timing your entries. First of all, we wait for the breakout confirmation. Don't anticipate a breakout before it happens. Only enter a trade after price has clearly broken above or below the NR7 range. Number 2, you avoid multiple NR7 bars in proximity. If you see series or several consecutive NR bar, it could indicate a prolonged indecisiveness. In this case, wait for a clean breakout before taking your trades. As you can see in this example, you can see series of NR7 bar candles. In this case, you avoid taking a trade until you see a special or a NR7 bar that is clean, a clean NR7 bar. Now we look for a clean pullback if possible. Enter trades after pullback rather than at extreme highs or low. This can help you avoid fake breakouts and improve your risk to reward ratio. Now let's look for an example of an NR bar strategy. Let's look for an example. We'll look for a buy example and we'll look for a selling example. Now for this buy example, we can see, let's look for a better example. I'm looking for an example that has a pullback to make it easier for us to understand what we are doing. Now this is a good example. At this area, we can see our NR7 candle. At this particular area, let's observe what's happening in this area. First of all, to enter, we have to wait for price to break above the NR7 candle. This is the NR7 candle here. Price has broken above. Then we wait for a clean pullback. Price has pulled back to this particular area, the area of the NR7. This is the pullback at this area. Then price pull back. We enter our trade. Let's not forget our risk management is essential to protect your capital and maximize your profits when using the NR7 strategy. Let's not forget for long positions, we put our stop loss below the low of the NR7. The low of the NR7 candle, this candle, we put it below the low. When we put it below the low of the NR7, that's where we put the stop loss. After the retest, we enter and put the stop loss below the low to ensure that if the breakout fails, our losses will be minimal. Now let's not forget our risk to reward. We need to target at least 1:2 or 1:3. 1:2 risk to reward ratio. This means that for every dollar you risk, you are aiming to get $2 in profit. Let's not also forget our proper position sizing based on your account size and your risk tolerance. Never risk 1 or 2% of your account, more than 1 or 2% of your trading capital. Do not forget, never risk more than 1 to 2% of your trading capital on any single trade. So when you enter the trade, you put to mind your position size, you put your stop loss just below the NR7 candle. After price retest and it's going, when price retest and you see there is a sign of reversal, you enter your trade. Then you target 1:2 or 1:3 risk reward, as the case may be. This is how we enter the trade as seen in the example. Let's not forget, for bullish trades, price needs to be trading above the 20 exponential moving average before you can look for a trade setup. Price must be trading above. Then in case of a selling opportunity, price has to be trading below the 20 exponential moving average. Now, in conclusion, all traders, I believe we have come to the end of this video. Engage with us in the comment sections below. We want to hear about your experiences. Let's not forget that if we found this video useful or helpful to us, let's not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.